If most of what you're worth on paper is sitting inside the walls of your own house, there's something happening right now that you need to understand before it happens to you instead of around you. Here's the number that should get your attention first. For most Americans over 65, home equity isn't a piece of their retirement plan. It is the retirement plan. More of their net worth is tied up in their house than in every stock, bond, and savings account combined. Which means when someone tells you house prices might be about to fall, they're not describing an abstract economic headline. They're describing your actual number, the one you were counting on to cover the years ahead. 3 countries have already gone through exactly this. Not decades ago, right now, while you're watching this. Canada's National Home Price Index has fallen roughly 20% from its 2022 peak, a decline steep enough that homeowners who bought near the top are now sitting on paper losses they never expected to see in their lifetime. New Zealand has seen a similarly steep, multi-year slide, with some regions down even further. China's property market has been sliding for more than 3 straight years, dragging down the net worth of an entire generation who did exactly what you did, put their life savings into a house and assume that number only moves one direction. America hasn't crashed. Not yet, and not the way those 3 countries did. But something changed a few weeks ago that almost nobody explained clearly. And by the end of this video, you'll understand exactly what it is, what both sides of this debate are actually arguing, and what it means for the numbers sitting in your own home equity right now. Let's start with what actually happened, because the facts here are simple, even though the politics around them got messy. In late June, Congress passed something called the Road to Housing Act, a bipartisan bill aimed at increasing the housing supply and easing some of the regulatory friction that's made building new homes slower and more expensive for years. It passed the Senate 85-5. It passed the House 358-32. For context, almost nothing in Washington gets that kind of agreement across party lines anymore. When a bill passes with numbers like that, it means both parties, despite disagreeing on almost everything else, looked at the housing affordability problem and agreed something needed to change. Here's where it gets unusual, and it's the part of this story that got the least coverage, even though it's genuinely significant. The president didn't sign it. He also didn't veto it. Under the Constitution, when a president simply declines to act on a bill for 10 days while Congress is in session, it becomes law automatically, without a signature, without a press conference, without the usual bill signing photo. That's exactly what happened here. The Road to Housing Act became law on its own on July 11th, a bill neither fully embraced nor fully rejected by the one person whose signature usually turns housing policy into front-page news. Whatever that silence means politically, the practical effect is the same. The law is real, it's in effect, and it's already shaping decisions being made by builders, lenders, and city planners right now. Now here's the actual debate, and this is where you're going to hear 2 very different stories depending on who you ask. Because right now, serious economists genuinely disagree on what comes next, and both sides have real data behind them. One side of this argument says increasing housing supply is exactly the medicine an overpriced market needs, and that easing regulations to build more homes faster will gradually bring prices back toward what ordinary working families can actually afford, the same way increasing the supply of anything eventually softens its price. Economists on this side point out that America has been underbuilding homes relative to population growth for well over a decade, and that a supply-driven correction spread out gradually over years looks nothing like the sudden, panic-driven crash of 2008. Under this view, a slow, controlled cooling isn't a disaster. It's a correction the market has needed for years, and homeowners with reasonable equity cushions, meaning they owe considerably less than their home is worth, have relatively little to worry about even if prices soften somewhat. The other side points to what's already happening on the ground, not what a bill might cause someday, but what the data is already showing right now. JP Morgan is projecting roughly 0% national home price growth for 2026, essentially a market standing completely still after years of rapid gains. Some previously red-hot markets are already cooling in ways nobody predicted 18 months ago. Austin, Texas, one of the fastest-growing housing markets in the country during the pandemic, has become one of the coldest, with inventory piling up and prices in some segments already retreating from their peak. This side of the argument says a national policy specifically designed to increase supply, arriving at the exact moment demand is already softening in multiple regions simultaneously, could tip what looks like isolated regional slowdowns into something considerably sharper and more widespread than anyone currently expects. Both sides are the same set of facts. They're reaching different conclusions about how fast and how far this actually goes. And reasonable, credentialed economists sit on both sides of that line right now. Here's what almost nobody is saying clearly enough, and it's the part that actually matters for you. This isn't really a debate about whether home prices will go up or down nationally next year. It's a debate about which regions get hit, how hard, and how fast. And that distinction matters enormously if a meaningful share of your net worth is sitting in one specific house, in one specific zip code, not in a diversified national index you can simply wait out. So let's talk about what this actually means if you're 65 or older, because your position here is genuinely different from a 35-year-old buying their first home. And the timeline you're working with is shorter, which changes how much this actually matters to your specific situation. If you're planning to age in place, staying in your home for the rest of your life, a price dip on paper matters far less than the headlines make it sound. You're not selling. The number on a real estate website doesn't change your monthly reality if you're not converting that equity into cash anytime soon. And your home continues doing exactly what it's always done, giving you a place to live, regardless of what a market index says it's technically worth this quarter. But if part of your retirement plan involves downsizing, selling the family home and using the proceeds to fund a smaller place, plus years of retirement income, timing suddenly matters in a way it didn't a few years ago. A home that would have sold for a certain number in 2023 might sell for meaningfully less in a softening market. And that gap directly affects how much retirement income that sale actually funds, sometimes by tens of thousands of dollars, depending on your specific market and timeline. And if you're considering a reverse mortgage, converting home equity into income while continuing to live in the house, the math behind that decision is directly tied to your home's current appraised value. A softer housing market can mean a smaller available loan amount than the same house would have qualified for 18 months ago, which makes the timing of that decision worth a real conversation with a financial advisor. Not a decision to rush based on a headline alone, and not a decision to delay indefinitely out of fear either, since waiting through a prolonged decline could mean qualifying for even less later. There's a fourth situation worth mentioning too, one that rarely comes up in these conversations. If you're planning to leave your home to children or grandchildren as an inheritance, its value directly determines what that inheritance actually looks like on the other end. And a meaningful shift in home values over the coming years could change that number more than most families have thought to plan around. Here's the question worth asking yourself honestly, regardless of which side of this economic debate turns out to be right. If your home's value dropped 10% tomorrow, would your retirement plan still work? For some of you, the honest answer is yes, because the house was always just where you lived, not where your income was coming from. And nothing about that changes, no matter what happens to a national price index. For others, the honest answer is more complicated, and that complication is worth addressing now, with a clear head and real numbers in front of you, rather than in the middle of a market that's already moving, when decisions tend to get made out of fear instead of planning. Nobody watching this needs to panic. Nobody watching this needs to assume the worst version of either argument is automatically correct. And nobody needs to assume the most optimistic version is guaranteed either. What you actually need is to know your own number, the specific one, not the national average you saw in a headline, and to have an honest conversation with whoever helps manage your retirement about what happens to your specific plan if your specific home's value moves in either direction over the next few years. The bill that just became law without a signature won't decide your retirement on its own, and it isn't the villain or the hero of this story either way. But it's part of a much bigger shift already underway, one that's already reshaped housing wealth in 3 other countries, in ways their own retirees genuinely didn't see coming. The honest answer is nobody, not the economist arguing about it, not the politicians who passed it without quite putting their name on it, knows exactly how far this goes here. What you can control is whether your own plan depends on guessing that number correctly or whether it doesn't have to.